Good morning, everybody, and thank you so much for joining us again today for our July installment of Coffee with Forethought. Before we dive in, just a quick reminder about our disclosures here. None of what we talk about today should be construed as personal financial or investing advice. It is for informational purposes only, and if you would like to see our full disclosures, please feel free to visit our website. As a way of introduction, once again, my name is Joel Johnson. I'm a planner here with Forethought. I work on our signature team, and I am joined once again by Jake MacFarlane, our senior research analyst. And Jake, I don't know about you, but we've got a lot to cover today because June was an exciting month.
Wait, did something happen in June? What's going on? Couple
Definitely had
things.
a few things, and I'm sure many of those events and things that we're going to talk about today are going to lead to some questions. And so great news, at the bottom of the screen, you should have a Q&A button. If you click there and send your questions in, Jake and I are going to be happy to answer as many as we can at the end of our meeting today. And if we don't have time to get to your question, rest assured we will have one of us or one of our planners here at Forethought reach out and make sure that your question is answered. And just once again, we can't answer anything specifically about your situation, but we're happy to answer those one-on-one with you after the webinar. So Jake, why don't we go ahead and dive right in? And these are going to be our key topics for today. Review what happened in June, all those interesting events and key topics. We're going to revisit the economy, look at our holy grail. We're going to look at what the Fed did, and I know you've got a lot of information on that we want to make sure we touch on. And then we're going to finish up with earnings season because it's been busy. I know you and the team have been busy diving into these companies and looking at them, and so we want to make sure we give our clients and prospects an update there and what we've been seeing. So let's take a look at June. So what the markets gave us, tech once again led the way. So when we did this in June, tech was the outperformer, as we represent here by the NASDAQ, that blue line that you see there. And you see the S&P 500, the Dow Jones, and then of course the international indice that we look at as well. Now this is only looking over June. We did have a little hiccup there in the middle of the month, but since the beginning of the year, it's really been tech that's led the way. And Jake, I know that, when we look at the S&P and the NASDAQ, it being so heavily weighted in tech, that's certainly been a concern of ours, but it seems to have been working for clients over the last month.
Oh, no doubt about that. I think if you look at those indexes, as you mentioned, more and more of that total pie is represented by just a handful of big tech or communications companies, and they are highly correlated with one another as well. And so that was a big concern for us. Now, we own a lot of them as well, and certainly with what we've seen in this earnings season, and we'll dive into that a little bit deeper. But those big tech companies and kind of overall have really led the way from an earnings growth standpoint as well. But I think it's interesting to see as we go into looking over the last year, Joel, is that how the international markets have done. And they were kind of a lagger over the last month, still having positive return. But I think this slide on the right, Joel, really paints a good picture of like why it's so important to remain diversified. And international had been a losing bet kind of over the last, even like 20 years. If you really even go back, at least to the post GFC, right? The domestic trade has really won out. But what we've seen this year and that gap represented by the MSCI International Index being at almost 20% return versus the domestic indexes, which are positive, but in the mid single digits. Joel, just curious on your thought there.
Yeah. First, for those of you playing acronym bingo at home, GFC, Great Financial Crisis.
Thank you.
But yeah, Jake, you're exactly right. You look at what's happened year to date, and I think when we talk with our clients, especially during the client meetings, we tend to fall into this short-term bias where we look and we say, tech's been great over the last 2 months. Why wouldn't have I just owned that? And so having that experience of kind of zooming out and looking at what's happened over longer periods of time, giving that perspective, just like you pointed out, having that diversification. Now, we certainly see some ups and downs. Now, the one we do want to point out, obviously, that big dip that we saw in April, you'll remember that's when the tariff conversation started. And we had a lot of conversations with clients regarding that. You saw quite a few down days in a row. That always creates angst in our clients. And we're on the phones and we're having those conversations. And what we wanted to point out today is a couple of things. One, like Jake mentioned, diversification. But two, time in the market is more important than timing the market. So being able to get through that dip, you see how quickly it came back up. And if you just missed a few of those days, it can really hurt your long-term performance, which is what we try to focus on as good long-term investors. And I think really to hone in that point, one of my favorite charts, and I'm sure you've probably seen some iteration of this before, but what happens to your long-term returns if you were to try timing the market and not just staying invested through volatile periods like what we just pointed out on that previous slide? And that's what this goes over for you. So over on the very far left, you see the S&P annualized return over the last 25 years has been just above 8%. You've stayed invested. That includes the GFC. See what I did there? And a couple of other really big blips that we've seen over the past 25 years. You can name them off the top of your head. COVID, Brexit, a whole host of other things. If you had missed just the 10 best returning days, which in April, we actually had the third largest daily gain over the 25 years, your return would have gone from 8% annualized down to 3.7 rounding annualized. That is a huge difference in annualized returns. And the impact that that can have on plans and financial planning is very significant. And so that's why we always try to take that zoom out, stay diversified, and stay in the market. And just to kind of put this in context, that third largest day of return over 25 years, it was preceded by back-to-back down 4.8 day, quickly followed by a down 5.98. And so if you're looking at your portfolio, that's very tough to see. That's why we're on the phone, and that's why we're encouraging clients to stay in the market, because if you had missed that big return on April 9th, you would have significantly impacted those long-term returns.
Yeah, and Joel, I think this chart is so impactful, and not to like belabor this point, but just to kind of piggyback on that, timing the market, especially when you take big swings of like going from fully invested to fully cash, like that requires you to be absolutely right multiple times. Like there's multiple decisions there on when to sell out, and then also probably more importantly, when to get back in. And I think that like the context there of the third largest daily gain that we saw back in April, like it came right after terrible days that, if you sat through that and you were in cash, you're celebrating, right? But you're not thinking about, okay, great, now I'm going to get back in because the data looks better. Like there was no better data that was out there that would have made an informed decision to go ahead and get back invested. And so that's why, we try to just take that out of the equation and just build a well-balanced portfolio that can stomach those volatility periods when we see it, and also take advantage of buying great companies at lower prices at that point. But certainly, we're not taking those big swings. And just to put some real numbers behind it, if you whether you looked at like the S&P 500 or the Nasdaq, like we just saw that those indexes had good months over June. Both of those indexes were in a 15% correction or greater from the beginning of the year through to April. And so there's a lot of bad headlines out there and a lot of bad news. And some investors got out of the market at that point. And what was then missed, if you just remained in cash from that point, was rebounds of at least 25% in the S&P 500, and the Nasdaq was even higher. It's up about 33.5% since that correction there in April. So again, when we talk about like our key tenets, one of them is that we're not gods. Like we don't have a crystal ball that tells us what the market is going to do tomorrow. And because of that, and because of the data, the overwhelming data that shows that time in the market is better than trying to time the market, is again what really builds up our investment philosophy of staying diversified, buying great companies, and staying, for the most part, fully invested.
Absolutely. Great point and great perspective. Now, moving on to some of the data, looking at the bond market here, the yield curve didn't really move that much over the last month. You do see over the last year, it has improved significantly. Again, a good healthy yield curve. Shorter term, you would expect a lower rate of return on that money compared to that longer term there. And we're starting to see that get closer to a healthier yield curve. And so this is something we're keeping an eye on. But right now, it's kind of in flux with some of the things that's going on with the Federal Reserve that we have a much more detailed conversation to have in a second. But wanted to give you an update on the bond market and just look and see where that yield curve is today.
Joel, what would you think? That's probably the only facet of this presentation where we haven't had a lot of news in the past month has been the bond market. Am I right?
Yes, and over the last year, that's a good change of pace.
No doubt about it. Yeah, so let's get into some of the key economic data points that we look at. Especially this is our holy grail, right? And I think this is so impactful, especially being something that we check on every month. And so some of these numbers and some of the trends are important. And so I wanted to kind of take a pause and look at, from our presentation last month, what are some changes that have taken place? And I think there's one big one. Actually, the very first indicator being housing starts that actually went from a yellow into a red. And what we see there is not only is the 1 year down about almost 5.5%, but that's from a trend perspective. Actually, it kind of accelerated over the last 3 months, where it's down about 7.3%. Now, in our investment committee, it's not something that surprises us, as we had kind of a rubber banding effect post COVID, where housing starts, especially in our area in Florida, really just like accelerated at an unsustainable pace. And now that's coming down to earth a little bit there. So that's one that has moved to red, but I would say on a worry scale is probably not that high. And I think housing prices have already kind of adjusted, and maybe a lower supply is maybe supportive of housing prices looking into the future too. Not making that prediction, but that's why we're maybe not so nervous about it. Me personally, I'm a little bit more nervous about going down the list to kind of consumer and looking at retail sales and auto sales. I mean, these are indicators that are still green because over the last year, we still had pretty positive growth there. Retail sales about 3.5%, autos about 4.25%. Those are healthy numbers. But looking at the more recent trend figures that we're seeing, retail sales down actually over 1% in the last 3 months, and autos down about 12%. Now, what is important to know is that any sort of sales data or anything like that is going to have seasonality effects. And so that's why we don't really give a huge great preference on the 3 month, and we tend to look at the year over year changes instead. But that is one that we're keeping a close eye on, if I were to say anything, because overall health of the consumer is something that we are a little bit worried about coming into this year.
Yeah, and I think it ties in perfectly with what you were just talking about with housing, right? Yeah, the higher interest rates just across the board, whether it's you're buying the home or you're buying the vehicle. We saw that giant rubber band like you were talking about during COVID in both of those segments of the market. And we have seen some on the housing, and you're starting to see more incentives on auto as well. But still, you're looking at buying that new truck or that SUV, and it's still an elevated price to what we saw pre-COVID, and now at higher interest rates too. That payment is putting quite a bit of pressure on households. And so I think it's a great thing to point out. Like you said, we're not making any major changes based off of this data at this point, but it's something to keep an eye on because we are a consumer driven economy. And so, as goes the consumer, so will the economy. So, it's certainly something to keep in the back of our minds.
Yeah, and one other thing too, Joel, as we're kind of just riffing on this, but like that inflation effect is still real in terms of like what things cost now. And everybody talks about how, at least in our industry, inflation's coming down. And that
Yeah.
is true. Like that percentage of CPI is coming down, but it's still positive. So what does
Yeah.
that mean? It means that every year, if this were to continue the pace we're on, prices are going up by about 2 to 2.5%, let's just say. but that was higher for the last 2 years. So that effect of like what consumers are buying, if their behaviors haven't changed, it's taking up more and more of their wallet share, especially because that inflation or the prices have increased, generally speaking, at a faster rate that wages have increased. Now, that relationship has sort of flipped more recently, where wage growth has been a little bit higher than the current inflation rate. But that like cumulative effect over the last, really since COVID, I think is starting to eat at wallet shares a little bit more. And folks are starting to, we haven't really seen it, but the more recent sales data on the retail side paints a picture that maybe consumers are finally starting to slow down a tiny bit.
Yep, we've definitely reduced the amount of eggs that we eat in our household. I can tell you that. So sticking with the economy here, Jake, let's jump right into the Fed and the monetary policy. Now, just as a reminder for everybody, the Fed controls monetary policy. The government, specifically Congress, controls fiscal policy. And so the Fed just met. We got a big decision from them. So Jake, why don't you tell the folks kind of what we heard, what we saw, and where we think it's going?
Yeah, absolutely. And to kind of take even a step back here, I always use this example that the Fed operates as kind of like the fulcrum, of a delicate policy scale, like a literal scale, and they have a dual mandate. So on one side of the scale, they have the goal of achieving maximum employment, and that's keeping the unemployment rate low, a healthy job market. On the other side of that scale is to keep prices relatively stable, and that means some inflation. You don't want to have prices that are falling. That has a lot greater issues. But a more moderate level of inflation, say around the 2% target long-term rate. And so each meeting, right, you have all these different chairmen of different banks, and overall, Fed Chairman Powell is kind of driving this discussion on balancing those two scales for kind of a healthier economy overall. And inflation, so one side of that scale, right, has come down. And so a lot of like market participants are kind of saying, hey, if inflation's coming down, that's doing better. The Fed raised rates to kind of push inflation lower. Now that inflation's come down, why isn't the Fed lowering rates at a quicker pace, as they've kind of paused for the last couple of quarters now? And I think the big thing is that not only they're not just looking at like the backwards, year over year inflation data, they're also making a lot of economic projections and using real time data to make forecasts of economic indicators. And so I put a list here of kind of the three main ones that they highlight in their summary of economic projection report. And this is for 2025, and it kind of looks at like what they expected 6 months ago, back in December of last year, versus what they expect now. And it really paints a picture of kind of a weaker economy overall. And so if we look at real GDP growth, that was expected at around 2%, now 1.4. Unemployment rate a little bit higher than what was previously forecasted. But I think the big one is on the inflationary side, which was expected to be at 2.5% and is now expected at 3%. And now this is using their PCE inflation. Not to get into all that, but basically, I think the big picture that the Fed is wrestling with is overall forecasting a weaker economy, which could, prompt them to want to ease policy and move interest rates down to stimulate the economy. But the scale or the weight of inflation is just too strong right now, given all the uncertainty from tariffs and maybe supply chain disruptions. And so that weight of what's maybe to come on the inflation side is just not letting the Fed lower rates, even though he's facing a lot of external pressure right now, especially from President Trump. And he's having to, retain, be a neutral party and look at the data as it's coming in. But right now, while tariffs are still, we've gotten a little bit of clarity there, but there's still a high degree of uncertainty on what that effect's going to be, especially on inflation. It's going to be tough for the Fed to make meaningful rate, decreases while that risk is still elevated.
Yeah, and I think you really got to feel for Chairman Powell. I mean, he's got a big job to do out there. You painted a perfect picture here, that dual mandate of keeping people employed, but then also keeping inflation down so that we don't have to worry about the consumer as much because prices aren't increasing as much. And so big mandates, but then we really don't give him that many tools to achieve that dual mandate. Essentially, what you're looking at is interest rates, which we just hit on. You can raise them, you can lower them, but then also how monetary policy, how much is the Fed either buying or releasing in essentially bonds to the consumer? So changing the money supply in the general economy. That's really all they end up having. And so I think it's exactly what you're talking about, Jake, with all the uncertainty and the data just not quite showing what they're hoping to see. You don't want to start using those bullets quite yet, just so that if something does happen or something drastic changes later on in the future, you've still got those bullets in the chamber to take up whatever effect that you need to. And the other thing that I would point out on this too, this has a lag. So if they were to cut rates just now, you wouldn't see that effect in the overall economy for about 3 to 6 months, is typically what we've seen. Now, we saw it on the poor end of that decision just a couple of years ago when they were raising rates and expecting inflation to come down. Most people would consider them behind the eight ball on that. And so what they're looking at now is kind of trying to change that perspective in the future and not going too early on this. And again, they do try to be data dependent, and you hit it perfectly. That neutral third party. What's the data telling us? And when you have uncertainty in data, it makes it very hard for them to forecast on what's going to happen. And so I think it's a good idea for them to continue holding, but we're going to see what the rest of the year provides us.
Yeah, let's jump into the earnings snapshot, Joel. I'm curious to kind of get your thoughts here on, going sector by sector, kind of overall. It seems like the same issues that the Fed is facing, right, with like the unknown, especially around tariffs. A lot of these, C-suite executives are facing those same uncertainties, and so it's leading to some, I think, interesting earnings calls. As I've seen, transcripts and. We'll get into some specific companies, but Joel, overall, right? What are you kind of seeing for the S&P 500 here?
I'd say surprise. If I had to summarize it with one word, I think it'd be surprise. We entered this year, I think, more pessimistic on the outlook for the economy, and specifically with the companies that we own, or the companies in the S&P, which is what we're looking at here. And so expectations for them were rather depressed. And what we've seen is these companies come out and tell us, listen, it's actually been pretty good. We're still generating plenty of revenue. That revenue is dropping to the bottom line in the form of earnings for shareholders. But what I think we've seen, and Jake, you can speak more to this than I can, the moving forward projections is exactly where they're kind of hitting the brakes. And it's more sector by sector, industry by industry there, because more will be impacted by certain things floating out there, specifically tariffs, than others would be. But a lot of these companies have been coming out and telling us basically, look, it's been great. We beat what you expected us to do. But moving forward, we're not so sure. So let's not get overzealous with expectations for the rest of the year. But boy, these scorecards that we received in the second quarter of this year, you can see there from the data across the board, it's looking pretty good.
Yeah, definitely a lot of green there. The only areas of red to kind of pick apart would really be on the consumer side, consumer staples. And now keep in mind, right, like that's a year over year growth. And kind of since like 2022, earnings for some like tech companies and stuff like that, weren't so great when inflation spiked. But the consumer staples companies, they actually held up their earnings pretty well. And so now we're kind of seeing the flip side of that, which is very interesting to see. But certainly, I would have to echo your sentiment there, Joel. That like if just looking like at the basic S&P 500, over 80% of the companies had a positive earning surprise. Like that is much higher than the historical average. And Joel, why don't you get into the next slide here, and I'll kind of segue us into some other interesting data points that I've seen in kind of looking at S&P 500 companies through this earnings season. I'll start with like what's kind of gone on this last month or so in earnings season, and what I call the word on the street, right? And this is like what the companies are talking about during their earnings calls. And, an interesting one is we talked about tariffs, right? 427 companies out of the S&P 500 mentioned tariffs, most of them multiple times. And in fact, a lot of it, we can use like AI now to get like the sentiment of the earnings transcript, right? Like, did they speak about this in a positive manner or a negative manner? And yeah, the tariffs always in a negative manner, right? Like these CFOs, CEOs are having a difficult time assessing like what that is going to do to their businesses, how it's going to affect consumer behavior going forward. And so what that has led to is a lot of companies haven't really issued great guidance looking forward. In fact, some companies have just said like, "Hey, it's at a shaky spot right now, and we just don't know. So we're gonna take our guidance back. We don't know if it could be better than that or worse." But also, we're seeing some more companies issue negative earnings per share guidance, right? So saying, "Hey, for the fiscal year of 25, we actually don't think we're going to make that much in profits or in revenue as we thought last quarter." So that is a potential, pig in the snake there that could be difficult going forward for some of these companies. But broadly speaking, the earnings growth that we saw around like the 10% mark, maybe a little bit higher for S&P 500 companies. If we look at Wall Street analysts, they expect that to continue over the next 2 sequential years. And if that hits, if we get 10% earnings growth for the S&P 500 in 3 consecutive years, that's something that I don't think has ever really happened. Or if it did, it's kind of immediately coming out of a major recession or something like that. So that's one thing that we were kind of pessimistic about. And as Joel mentioned, we have been pleasantly surprised with how earnings have shaped up. And I would say we're still a little bit cautious though about kind of the next 2 years. We don't know, quite honestly, if these companies can keep up this pace. Now, hopefully they can. But two companies I wanted to look at a little bit here. These are ones that we followed for like a long time, and I think it's like a tale of two cities with both of these companies, and it's all centered around AI. Like that seems to be, especially for tech companies, the only thing the market cares about right now when a company reports earnings. So the two companies here, one's Broadcom and one is Adobe. They both beat their revenue and profit expectations for the quarter, so that's great. And both of them raised their guidance, right? They weren't one of those 68 companies who had negative guidance. They said, "Hey, we actually think we could do a little bit better than what we thought before." Both companies were down a little bit post market, but I think it's important to also understand the context. On one side, you have Broadcom, who over the last 12 months is up over 70%. So it's been a great stock that was at, all-time highs basically when the earnings came out. And they forecasted that their AI revenue will reach about a third of their total revenue for the next year. And that's a great increase and a pretty substantial piece of their overall pie because they're such a big company. Adobe, on the other hand, they forecasted kind of less than expected AI growth. And a lot of analysts are pretty concerned about if they're able to really be able to monetize that AI side of their business to its full extent. And so after earnings, their shares were down even more. They were down 5%. But the context is that over the last year, Adobe is down 30% already. So it wasn't like they were trading at, an all-time high or anything like that. The baseline was much lower for Adobe, and they still weren't able to eclipse it, and shares traded down, even though the company beat and raised guidance, and the non-AI part of the business was doing really well. So that's just kind of the fascinating part of what we're doing now. Not to say that one company is better than the other, and not to make any recommendations or anything like that. It's just interesting when you look at these two companies, both seemingly on paper having good results, but the market right now is pricing these companies looking forward at how they're able to effectively generate revenue and profits from the AI side of their business.
Yeah, I did, and we always kind of tongue in cheek call that price to perfection, right, Jake? And you run into the earnings, and if these companies, especially on the tech side of things, aren't growing their top line revenues at double digits and hitting on every single metric, you get reactions like this in the market. And I think it goes back to our overall philosophy, right? Taking it back to the beginning of the presentation. Time in the market, not timing the market. Stay diversified because you don't know what's going to happen with individual companies, sectors, or parts of the economy. And then finally, here, valuation matters. You want to be taking a look at these companies and making sure that what you're getting into is something that you can expect over the long term to be a good hold for you in a portfolio. And I think Broadcom and Adobe, great little representation here of how just one quarterly earnings can move the market just in that quickly. Well, with that, thank you everybody for joining us. We're going to wrap it up here and move to our Q&A. But before I do, Jake and I would absolutely love it if you had anybody that you think might benefit from hearing this conversation. We would love to share it with them. This will, of course, be recorded and you're able to share it. And also feel free to send them the link for next month's, because we do expect to be here again next month doing this all over again, giving you some updates, because like we said, a lot of things floating out there that I'm sure we're going to be hearing about for the next 30 or so days. So thank you all for joining us, and we will talk with you again soon, and we'll move to our Q&A. All right.